During times like this, when crypto has already gone up quite a bit, I see a lot of people doing the exact same mistake. Many people think that because Bitcoin has made the 2, 3, 4, 5x returns, that now the upside potential for Bitcoin is very limited and that it's actually smarter to rotate towards more risk on assets like Ethereum, like Solana, like potentially the meme coins even. But I think there's a good case to be made that investing in a meme coin might have on average less upside potential and more risk compared to levering up Bitcoin exposure. So let's say one would buy Bitcoin with a 2 or 3x leverage. The upside might be much higher compared to just buying a meme coin. Fundamentally, the question is always about risk-adjusted return. Where do we get most return for the volatility, for the risk that we take on? And ideally, the asset that we are buying is not the asset that everybody gets excited about at the moment. And right now, everybody is super excited about Ethereum, right? Because of the Ethereum treasury companies. But have a look at the long-term Bitcoin dominance chart. This tends to peak at 73%. It tends to bottom at 38%. And it shows how important is Bitcoin within the crypto ecosystem. When Bitcoin is extremely expensive, we might subsequently see an altcoin rally. That's when Bitcoin dominance goes down. But for the vast majority of times, Bitcoin tends to actually outperform the altcoins. For the last 3 years, since August of 2022, Bitcoin dominance went up. And recently, we saw a dip again because Ethereum got all the attention. And so this chart really poses the question, doesn't it make sense to get into Bitcoin now? Maybe we see a V-shaped recovery, very similar to the end of 2024. Over here, it was Solana that made the race because of the excitement around meme coins, because of all the trading in the pump.fun ecosystem. This time it's Ethereum that's outperforming. But again, historically, we tended to see an altcoin rally only after Bitcoin dominance was close to 73%. So maybe the best risk to reward currently is in Bitcoin. Maybe a levered bet on Bitcoin if you want to be more risk on. Let's talk about the thing that everybody is overlooking. Everybody looks at the Ethereum treasury companies, everybody looks at the Ethereum ETFs, but now the Bitcoin ETFs aren't getting discussed that much anymore. But the data around the Bitcoin ETFs is extremely encouraging because long-term Bitcoin's inflation rate is only 0.84, 0.83%, and it will even get cut in half 1.5 years from now. But at the same time, the Bitcoin ETFs buy on average 2.6% per annum of the supply if we annualize the last month of demand. And we don't just have the Bitcoin ETF, we've also got the demand by the Bitcoin treasury companies, headed of course by Michael Saylor and Strategy. In the end, the investors that make most money long term are the ones that buy fundamentally sound assets at a discount. So the asset should appreciate long term. Ideally, we buy it at a discount. Ideally, we buy this with leverage as well. In the property market, for example, that's a very common strategy. If there's, for example, a housing crisis, property prices went down a lot, and then you're buying the fundamentally sound property, for example, the apartments in the city center, and you're also doing this with leverage by using mortgages, then you can have multiple X returns in the span of just a few years when we recover again. With Bitcoin, it's kind of like the same way. Bitcoin will stay around. Bitcoin is adopted globally. Bitcoin has now regulatory clarity. Bitcoin will, over the long term, appreciate, especially versus fiat currency. So the Bitcoin inflation rate is only 0.8%. The purchases by the ETFs outpace that. But then also we've got the Bitcoin that gets lost over time. This here is the percent of BTC that has not moved for at least 5 years. And it tends to go up over time. And again, this is as a percent of overall supply. So Bitcoin gets lost faster, or at least it gets accumulated faster by the people that never sell it compared to how quickly the supply is expanding. So this is long-term upward pressure. Then of course, we've also got monetary debasement. So this is now USM2, how many dollars are actually floating in the system. And while it seems like the growth isn't really that constant, once we look at this on a logarithmic scale, this is just going straight up. This is growing by 6.8% per per annum. This is how fast money is actually expanding. This is also why the stock market is appreciating. And so really, if the technology doesn't suddenly fail, then Bitcoin is bound to appreciate long term. In this video, we're going to discuss how quickly is it likely going to appreciate long term. Because the spot Bitcoin ETF volumes are constantly high. Every single day we see billions of dollars getting transacted through the exchange traded funds. And the establishment has a vested interest to keep this alive. BlackRock has the vast majority of those trading. In terms of trading activity, IBIT has now a market share of more than 80%. And while on the daily time frame, it seems like the spot ETF volumes are fluctuating somewhat, it seems to be going up and down around zero. Very long term, the trend is clear. This is now the assets under management in the Bitcoin ETF. The chart starts at the end of July 2024. So a bit over a year of data. It went from 60 billion to more than 160 billion. And here's the assets under management measured in Bitcoin. So this is just going straight up. All the volatility in the US dollar chart is just due to the Bitcoin price going up and down. But really, Wall Street is long-term accumulating Bitcoin. It's putting another source of long-term buying pressure on the asset. And so really, I believe that the attention around Ethereum is currently way too high. I believe that Ethereum is currently getting hyped. I believe that Ethereum is currently overvalued, at least in the short term, relative to Bitcoin. Have a look at the revenue by grayscale, for example. Bitcoin versus Ethereum. BTC is still way more relevant than Ethereum is. And while the trading volume of the Bitcoin ETF is dominated by BlackRock, the actual on-chain holdings are also going up, but it's not as imbalanced. There's only quote-unquote 51% of Bitcoin held by Larry Fink. As a percent of overall supply, the ETFs become more and more important over time. When there was only grayscale, we had 4.7% of the Bitcoin supply held by the ETFs and by the trusts. Again, within one single year, this grew all the way to 7%. And there's not only the ETFs in the US, right? There's also Hong Kong, for example, that continues to accumulate. And again, it's not just the ETFs, it's also the Bitcoin treasury companies that tend to buy at an even accelerating rate. And so let's say we play with the assumption that there's some money on the side, some play money that we can gamble with, right? So the idea is, should we buy a meme coin or two meme coins that can potentially do 5 or 10x, but they can also go to 0? Or should we, as an alternative, and that's presented in this video, maybe buy Bitcoin with leverage? Both of those propositions can, of course, completely destroy the capital. But again, this is just the idea of having money to gamble with, right? Money that has potentially positive expected value, but where we actually want to get our 3, 4, 5, 6, maybe even 10x returns. What's actually the smarter way to go about this? Let's try to figure out the upside potential for Bitcoin here with leverage. What we've got over here is the stablecoin market cap. How much money is currently in the crypto space? And it shows very nicely how money is flowing into the space and out of the space. When people are sending their hard-earned fiat currency into the crypto ecosystem, then this is going up because there's a conversion happening from fiat into stablecoins, right? New stablecoins are getting minted. When people are withdrawing their funds from crypto, then this is going down. People exchange their stablecoins back for fiat currency. Now, why did this even turn around over here? That was the collapse of Terra Luna, of the Anchor protocol, right? This is where Do Kwon got into trouble. People suddenly started to get very skeptical around decentralized finance protocols, and they wanted to get their money back. This is why this turned around. But since October of 2023, the stablecoin market cap is going back up again. And so let's see how much it actually went up. Let's see how much Bitcoin appreciated during that time. The stablecoin market cap since October of 2023 went up by 107%. Bitcoin during the same time, it appreciated by 320%. So a bit less than a 3x appreciation compared to the money inflows. Now this is very much expected because $1 deployed into the crypto ecosystem appreciates the market cap by more than $1. There is an inherent leverage here. Now let's see how much the stablecoin market cap appreciated in the last 12 months. The answer is by roughly 52%. Bitcoin did not appreciate by 150%. It appreciated by a bit less, so only by 95%. We've still got our leverage, but there is of course a bit of volatility in the Bitcoin price as well. So we can expect maybe a 2 to 3x leverage on top of the stablecoin expansion. Stablecoins appreciate by 50% per annum right now. So it's reasonable to assume that Bitcoin will at least double in the next 12 months, given that we don't have another black swan event, right? If Binance stays intact, if all the stablecoins will stay around, if no Bitcoin treasury company suddenly has to sell their Bitcoin, if all of those conditions are met, a doubling of the Bitcoin price in the next 12 months, I believe, is very reasonable. If we now lever this up, because we are gambling with the money, right? Because we want to get more risk exposure, because it's just money on the sidelines. Then let's say we put a 2 or 3x lever on that. Suddenly we've got a 6x on the capital. I'm not recommending to do this with the retirement savings, but let's say you're a student in your 20s and you've got a bit of money on the sidelines. And if you lose all that money, it's fine, because you will get more money in the future. You've got a growing career ahead of you. You've got some money that you're willing to lose. Then putting now a 3x on Bitcoin, keeping this for the next 12 months, I believe is very reasonable. It's a reasonable thing to do. It is always a matter of risk to reward. It's always a matter of risk tolerance. How high is our net worth relative to our income? If our net worth relative to our income is relatively low, then we can pretty much gamble with the money, because it's fine. We will be able to recoup the funds very, very quickly. If our net worth relative to our income is very high, let's say we've got 4 or 5 years of income, of course we should not gamble all of that money with 3x leverage on Bitcoin. So it very much depends on the individual circumstances. Still, I do believe that using a levered bet on BTC right now makes more sense than buying random meme coins. I don't think that the upside for meme coins, at least let's say a diversified portfolio of meme coins, 3, 4, 5 meme coins, I don't think that such a portfolio will outperform Bitcoin in the next 12 months. Again, because I don't see altcoin season happening that quickly. Bitcoin dominance is artificially low right now. We tend to see altcoin season only once Bitcoin dominance is close to 70%. The reason for the drop is clear. It's because all eyes are currently on Ethereum, but the demand for Bitcoin is constant. The purchases by Wall Street happen all the time. The purchases by the Bitcoin treasury companies happen all the time. They outpace Bitcoin's inflation, and they outpace the rate at which Bitcoin gets lost. And buying Bitcoin right now, potentially with leverage, is, I believe, comparable to buying a house during a crisis with a mortgage. The idea is always we want to buy the asset that's long-term fundamentally sound, and we want to buy the asset at a time when it's comparatively cheap. Now in US dollars, Bitcoin isn't necessarily cheap, but relative to Ethereum, relative to the altcoins, I believe it's still cheap enough. Now fundamentally, there are 2 ways to make money with investing. The first way is to just bet on long-term adoption and to bet on monetary debasement. So that's the idea of dollar cost averaging, right? We buy into Bitcoin all the time. We just bet on the long-term growth chart. For example, had you bought $1,000 worth of Bitcoin every month for the last 5 years, so you held Bitcoin for more than a single cycle, then you'd now have $213,000 worth of BTC, and you outperformed the S&P 500 and the gold market by more than 2x. The reason why such an approach works is because more and more capital long-term flows into the asset. So more people buy the asset without the intention of selling it. More and more people just buy the asset in order to preserve purchasing power. This works with Bitcoin. It also works with the property market. It also works with the stock market. People don't necessarily buy those assets in order to flip them quickly. So have a look at the number of wallets that own at least one Bitcoin. This tended to go up long term. This growth has stopped to a degree 2 years ago, but now we've got Wall Street that instead buys the Bitcoin. So there's still long-term adoption, and thus Bitcoin price appreciation. The treasury companies, they never sell, and the ETFs also rarely sell. There's only very few instances where we see net selling. We really have to zoom in to see those kind of events. So that's approach number one, right? We bet on adoption, we bet on further capital accumulation, but then there's also approach number two, and that's trying to beat the market, right? It's trying to buy low and sell high, and effectively what we're doing there is we're taking money away from the person that's not able to time the market as well in order to get outperformance. So if you want to get more performance than the average investor, we're effectively taking it away from the investor that doesn't really know what they're doing. So let's say we are using tools like the realized price, right? The average cost basis of the market, and we buy much more Bitcoin whenever the current price is below that realized price. Then of course we are buying when everybody is very skeptical about crypto and Bitcoin. We are in a way doing a contrarian bet. Nobody wants to buy Bitcoin, so we do. The same is true when Bitcoin is high, right? For example, here, the CBBI indicator, we want to sell when this is rather high, when everybody is hyped about Bitcoin, when everybody thinks that Bitcoin will go to the moon, and the rally accelerates. That's when we want to potentially exit. We are not yet at those extremely high levels. But again, we always want to do the opposite of what most other people are doing. Because that's the way to make money in crypto, right? The minority is able to beat the masses. The masses tend to do the wrong things. Only the people that do the opposite of what most other people do, they accumulate above average returns. If you do a 2x on top of just buying and holding Bitcoin, then you basically took all the money away from somebody else, or you took 50% away from two other people. You get the gist. And so that's why I like the crypto market. And that's why I don't speculate, for example, on the currency market, because the currency market is extremely efficient. It's got all kinds of quants and hedge funds working for it. It's a very large market. It's incredibly hard to beat. When we are taking money away from the people that aren't as smart in the market, we're basically seeing all the other market participants as competitors. And we want to have very weak competition, not strong competition. We don't want to have the Einstein hedge funds as our competition. That's why the currency markets are very poor for active speculation for the average person. And the same could be said potentially for the stock market, right? The stock market also tends to be somewhat efficient. Before my time in crypto, many years ago, I was actually a professional poker player. I paid my study fees, my private tuition with the earnings from poker. I lived from poker several years. I used to live in Gibraltar at the time. With poker, I learned that it's not just the skills that matter. It's not just about calculating probabilities and reading tells, etc. It's also about who you're sitting with at the table. If the table is only made out of sharks, it's only made out of other professional players, then there's no money to be made. But if you're sitting at the table where all the other players are just beginners, then you don't need that much skill in order to beat the game, in order to make money. And it's the same concept here for speculation. If we want to outperform the average investor, we better participate in assets and in markets where we're mainly sitting at the table with fish, not with shark, right? We want to be in a soft market, in an inefficient market. And so here is where I see the inefficiency in crypto. Crypto as a whole is already comparatively inefficient, at least in relation to the currency market or to the stock market. But really, the main inefficiency comes from token dilution. For example, have a look at this. The ape token has a lot of token dilution. Here is the number of ape tokens over time. 3 years ago, this was at 284 million. Now it's at 908 million. There's all of those new tokens that get issued all the time that goes to the insiders and to the team and to early investors, etc. They get new tokens and they dump those tokens on the market. And this is not a new concept I'm talking about just recently. I even talked about this specifically for the ape token just a few months ago. Have a look at this video. How solid is the Altcoin rally? This was published 9 months ago on the 22nd of October. At the time, the price was at $1.57. And here we are today at 63 cents. We had a massive rally in the ape price at the time, but relative to Bitcoin, ape went down massively afterwards because the rally was triggered by some news event, right? People got very excited about ape and then the insiders dumped very quickly. It's something that's not really surprising. This is an underperformance of 78%, and this is one sign of market inefficiency, right? If everybody is buying into a rally, despite the terrible tokenomics, that's an opportunity to make money. We're not buying ape, we do the exact opposite. We are selling ape that we don't have. We are shorting the ape token. In other words, we make money whenever the price loses versus Bitcoin, Ethereum, Solana, the major cryptocurrencies that tend to appreciate over time. Now, ApeCoin is just one example. The whole altcoin market has this problem, and the problem is massive. It's a structural problem that won't change anytime soon. Have a look at the value of the token unlocks of the newly hitting tokens that come to the market every single week. It tends to be at around 1 billion per week. $1 billion of tokens need to be purchased every single week just for the altcoin prices to stay flat. Now, the counter argument is that all cryptocurrencies are inflationary to a degree. Even Bitcoin is. But compare this with Bitcoin. Bitcoin's inflation rate is at 0.83%, and that is per year. The market cap of Bitcoin is 2.34 trillion. So when we multiply the numbers, we've got potential sell pressure of 373 million per week. Roughly 1/3 of what the altcoins need to be bought at. So Bitcoin has less selling pressure, and at the same time we've got all of the supply absorption by the ETFs and by the Bitcoin treasury companies. And so when there's an asset that's less inflationary, that has less sell pressure, and at the same time has more buying pressure due to Wall Street, then of course that asset has to outperform. And historically we have exactly seen that. Since beginning of 2022 to today, the Bitcoin market cap relative to the others market cap, so the market cap of the smaller altcoins, has gone up by 291%. But this is actually underrepresenting the problem, because this is again just comparing market caps. But the prices tend to go down for the altcoins much faster because of the token dilution. So let's say we've got an altcoin of $1 billion of market cap. Now we double the amount of tokens, and thus the token price gets cut in half. The market cap would still be the same, right? The token price went down by 50%. The market cap is unchanged. So the underperformance that we get from the token dilution isn't even presented here in this chart. This chart just shows how long-term people are exiting the altcoin market in favor of, in this case, Bitcoin. But the chart relative to Ethereum and relative to Solana looks pretty much the same. Here's another example to show the difference between price and market cap. This here's WorldCoin. WorldCoin supply went from 522 million to currently 3.8 billion. So roughly a 7x in the supply in the span of just 2 years. The WorldCoin price is close to all-time lows. The WorldCoin market cap is quite close to all-time highs. It's not that close to the low. Again, the market cap can be rather stable while the price is crashing. Again, the market cap can be rather stable while the price is crashing. So really, you're getting the return of the price, not of the market cap. And that's why most retail investors lose over time. Have a look at Bitcoin relative to WorldCoin. It's just going up. Or have a look at Bitcoin relative to Ape. It's also just going up. And this is, I believe, the key to making money in crypto. It's to take advantage of that inefficiency. It's to make money with all of that marketing dollars that are spent by the team, by the early investors, to attract other retail investors to buy things like ApeCoin or WorldCoin. So then a lot of liquidity is in the token that then the insiders can dump on that liquidity. But we can make money from that dumping simply by betting on falling prices of ApeCoin or of WorldCoin, at the same time betting on rising prices of Bitcoin, Ethereum and Solana. So we're playing exactly the delta of those two assets. That's why we get this long-term appreciating trend. I just took those two examples over here. But again, this is a structural problem with the altcoins. The selling is much, much higher than the market can digest. It's even higher than what we have for Bitcoin, as we've already discussed. I'm making money with those relative valuation bets already for more than 4 years. And had I just dollar cost average into Bitcoin, I of course still would have made a lot of money, but because of the relative valuation bets, I didn't just get the return that's indicated here by the gray line. I got the return that's indicated by the black line. So this is something I'm doing already for a long time, quite successfully, quite consistently. And recently I even started a capital pool for the premium members where I execute exactly that strategy. And so far, after 1 month of trading, this is already bringing us annualized 74%, very consistently with a maximum drawdown so far of 2.6%. So really, I don't think that the edge in the crypto market is to find the next 5 or 10x altcoin. I think the edge in the market is to simply continuously, quickly grow the capital with little volatility, but to use the market structure to our advantage. With a random meme coin gamble, we can only invest a few hundred, maybe a few $1,000s. But when we actually have consistent growth with not that much volatility, suddenly we can invest much more capital, right? Investing a lot of capital into Bitcoin feels much better than investing a lot of capital in a small meme coin, right? We can deploy more capital. Thus, even if we don't have 10x returns in the span of a few days, it doesn't matter. If we've got above average returns consistently, if we've got a high Sharpe ratio, we are okay. Now, unfortunately, due to extreme demand, I had to close deposits for the copy trading pool. There will be a new capital trading pool starting at the beginning of next year, but right now I simply trade with the capital that I got from the members. But you can still manually copy trade me. For example here, right? This was the WorldCoin short. I bet on falling prices of WorldCoin and on rising prices of Ethereum. That was on July 23rd. And so many premium members simply copy trade me, right? There is quite a lot of gains to be made in those individual transactions. But it's not about the individual transactions, right? It's about the long term. It seems like quite complex, right? We go long one thing, we go short the other thing. It also sounds quite risky. But really, in the end, if we set this up properly, it's not that risky and it's also not that complicated. There's really only 2 videos to watch. It's this one, using perpetual futures on Hyperliquid, and here this one, probably even more important, risk management with relative valuation bets. It's only 1 hour of content. After this 1 hour, you know exactly what to do in order to get performances like this. And you will also know what to do in order to just copy trade whatever I do, so that you get the same kind of returns that I do. So really, just watch this video and watch this video, and you're good to go. I'm not going to read it out in this video, but feel free to stop the video and read the feedback that I get. It's always nice to get this kind of feedback. If for whatever reason you do not like premium, then just message me within the first 7 days of signing up and I refund you the fee. It's currently $125 per month. If you don't like it, you'll just get that money back. Just message me. A link to premium directly pops up over here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.